Hey everyone, welcome back to Corporate Decoder, the place where we expose the accounting secrets of big businesses and honestly let you know if they're cooking the books or just having a bad quarter. Today we're diving into Cantor Fitzgerald Income Trust Inc.'s latest filing, and let's just say their credit facility is getting a serious makeover. Imagine you have a credit card, but instead of a little plastic rectangle, it's a massive loan for the whole company. While Cantor Fitzgerald Income Trust just got a much bigger credit card, and it comes with some new rules and a higher spending limit. This report, a Form 8K, is like a really important announcement that a company has to make to the public when something big happens. It's not like their regular quarterly report. This is for the juicy stuff, the big news. And this announcement is coming from Cantor Fitzgerald Income Trust Inc. They're a real estate investment company, what they call a REIT, which means they own and operate income-producing real estate. Think of them as a big owner of buildings, and they collect rent from those buildings. The main event we're talking about happened around July 16th of 2025. So what exactly did Cantor Fitzgerald Income Trust do that's so important? Well, they amended and restated their credit facility agreement. Think of this as renegotiating a really big loan with their bank. The bank involved here is Citizens Bank, and they are the administrative agent, meaning they're in charge of managing this loan for all the banks involved. BMO Bank also played a big role as a joint lead arranger. This isn't just a small tweak, they completely changed and updated their credit agreement. The big news is they increased the total amount they can borrow. They took their credit line from $125 million up to $150 million. That's an extra $25 million they can now use. But wait, there's more. They also built in an option to increase it even further by another $100 million. So, in total, if they need it, and the banks agree, they could have access to a whopping $250 million. That's a lot of borrowing power. Now, let's talk about the cost of borrowing this money. The interest rates have changed. This is really important because it affects how much money the company has to pay back beyond the original loan amount. So how they calculate the interest now depends on something called the term SOFR rate, or an alternative base rate. SOFR is a benchmark interest rate that's becoming more common, especially since the phasing out of LIBOR. The plus a margin part is how much extra the bank charges on top of that benchmark rate. These margins can range from 1.2 debt. They might get a slightly lower interest rate, and vice versa, edge with the font charges on top of that benchmark rate. These margins can range from 1.2 debt, they might get a slightly lower interest rate, and vice versa. They also changed some definitions in the agreement. Change of control usually refers to when a company's ownership or management significantly changes. Permitted properties likely refers to which specific buildings or real estate assets the company can actually use as collateral for this loan. So they're fine-tuning what counts as security for this big loan. And importantly, the loan now has a new maturity date, which is July 16, 2028. That's the date by which they have to pay back the principal amount of the loan. But they can extend this date for 2 separate 1-year periods as long as they keep meeting their financial promises, like paying their bills on time and maintaining certain financial ratios. And they also have to pay a fee for each extension. This gives them flexibility, but it also comes with conditions. Now, for this big loan, they've pledged specific properties as collateral. Think of collateral as the company's property that the bank can take if the company can't repay the loan. Here they list several properties like Louisville, Madison Ave, De Anza, and others. These are the assets backing this credit line. So as of July 16th, they already owed about $104.2 million on this credit facility. This new agreement is essentially restructuring and expanding an existing debt. They're telling us this summary is just a highlight reel. The full detailed contract is attached as an exhibit, and that's where you'd find all the nitty-gritty legal terms. And in this section, they tell us what other documents are part of this filing. Here it is, the actual contract, Exhibit 10, fine. This is the legal document that lays out everything about this massive loan agreement. And then there's this Exhibit 104, the cover page interactive data file. This is basically a computer-readable version of the main page designed for easier electronic processing. And finally, we have the signatures. This is where the company's authorized folks sign off, confirming that what's in the report is accurate. Here we see the signature of Christopher A. Milner, who is the president of Cantor Fitzgerald Income Trust. By signing this, he's confirming the company is making these statements. Now let's look at what this all means. Cantor Fitzgerald Income Trust is expanding its borrowing capacity significantly, increasing its credit line by $25 million and positioning itself to potentially borrow another $100 million. This signals a couple of things. First, the company likely has plans for growth, perhaps acquiring new properties or investing in its existing ones. A larger credit facility gives them the financial flexibility to seize opportunities. However, taking on more debt also means higher interest payments and increased financial risk. The new interest rate structure tied to SOFR and alternative base rates means their borrowing costs could fluctuate with market conditions. While they've secured more favourable margins for certain scenarios, they need to closely manage their loan-to-value ratio to keep those costs down. The extension options are a good sign of the bank's confidence in the company's ability to manage its debt, but they come with specific conditions. Cantor Fitzgerald will need to maintain strong financial performance to take advantage of these extensions, which means continuing to collect rent effectively and manage expenses. The fact that specific properties are listed as collateral is also noteworthy. This suggests that the company's real estate portfolio is the primary asset backing this debt, and any downturns in the real estate market could impact their ability to service this loan. Overall, Cantor Fitzgerald Income Trust is taking a bold step to increase its financial flexibility. This move could fuel growth, but it requires careful management of a larger debt load and a close eye on market interest rates and property values. It's a classic balancing act in real estate investment finance. Alright, that's our decoding of Cantor Fitzgerald Income Trust's latest credit facility update. What's your take on this increased borrowing? Does it signal confidence or concern? Drop your thoughts in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more corporate deep dives. And don't forget to join our Discord community linked in the description for even more financial discussions. Thanks for watching, and we'll see you on the next Decode.